interesting that when we start our planning session for 2024, that started right after the Labor Day weekend back in 2023. And when we were thinking about our keynote speakers for our launch meeting, right off the bat, the two areas that we keep hearing that more and more advisors want to hear from is compliance. Well, we listened and we delivered with Eric Wachtel a few moments ago. The second area that we hear that people want to hear mostly is the economy, what's going on with the economy, and they want to hear an economist. So we went out there and we found from Desjardins, we're gonna hear a fellow by the name of Marc Desormeaux, who's going to provide us with an economic update for 2024, what to expect and what to watch for here this year.
What I'm going to do today, thank you very much for having me. It's great to be here representing Desjardins. And what I'm going to do today is just take you through a quick overview of our forecasts for the next couple of years, highlight some of the major economic themes, hopefully only take about 15-20 minutes, and then the rest can be for Q&A if you like. 4 main points I'm going to make today. The first is around interest rates. We think that interest rates will be cut in the middle of this year as economic weakness becomes more obvious and inflation comes down more meaningfully. Second point is that we see less of a contribution from population growth than we have been seeing over the last year. Population growth will still be important. It will still be a major contributor, but it won't be as significant as we've seen this year. When it comes to housing, we actually think it's possible, despite these forthcoming rate cuts, we think it's possible that there will be a longer run drag from the housing market on Canadian economic growth. I'll talk about that. And then, of course, we have longer term questions around things like housing affordability, productivity, and of course, geopolitics, particularly these days. This is really just an overview of our forecast for the next year or so, the next 5 quarters. This is plotting GDP growth. That's the black dots there. You can see we have a mild set of consecutive contractions at the beginning of this year. And what's really important here are the dark green, light green, and light blue bars, which represent household consumption, residential investment, and overall business investment. These are the sectors that we think will increasingly drag on Canada's economic growth because they are sensitive to interest rates, which are still very high. Of course, as we do get those cuts, which I'll talk about in a second, then we'll start to see a rebound towards the end of 2024. This chart here really summarizes the big picture. What's important when we think about interest rates, when we think about monetary policy, is that it's forward-looking. When the Bank of Canada decides to raise or lower interest rates, it isn't necessarily thinking about economic conditions at the moment. It's thinking about 12 to 18 months down the road. That's when we tend to see the peak impact, the full impact of an interest rate decision, be it a cut or an increase. So what that means, if we look at the timing, is that right now, in the first quarter of 2024, we're really only beginning to see the peak impacts of the first few interest rate increases that occurred in the middle and at the beginning of 2022. Never mind the more significant 100 basis points, 75 basis point hikes that occurred later in that year. We still haven't felt the full effects, even though people are feeling the pinch from higher borrowing costs, from slowing economic growth. We haven't felt the full impacts yet, and that is the fundamental reason that we still think growth will go into a mild contraction in the first half of this year. Of course, Canada is particularly sensitive to interest rates and to the course of the housing market. What we've plotted here is just investment, the share of investment that comes from the housing market, from the residential sector. You can see that Canada compares favorably or unfavorably, depending on how you look at it, to all these comparator nations. That means that the drag from this delayed impact of higher interest rates will likely hit Canada particularly hard, at least relative to comparator economies. The US economy, we also think will slow because of some of the same effects, higher interest rates, delayed impacts from them, but it won't be as significant a slowdown as we are penciling in for Canada. And this goes back, if we just go back a few slides to our overall economic outlook, the orange bar, net exports, those should increasingly be a drag on Canada's growth as well with that slowdown in the US economy. So pulling all of that together, we think that inflation will increasingly moderate over the next few months. We did see a pickup in the annual rate in December that largely reflected commodity prices and the spike that we've seen there. But the general view here, and we're not outside of consensus in saying this, is that with more and more months of economic weakness, less demand within the economy, supply and demand will increasingly align, and price pressures will increasingly normalize. It'll be painful to get there, but it is something that we expect to happen over the next year or so. Accordingly, we think that as we progress through this year, the Bank of Canada will judge it necessary for rates not to be as restrictive, for them not to be as weighing down on economic growth as they have been, with inflation coming down. We think the first cuts will occur in April. It'll be clear at that point that the economy is slowing, that inflation is coming down, and the Bank of Canada will cut then. We'll get down towards about 3.5% by the end of this year, according to our base case. And then bond rates, particularly in the 2-year and 5-year space, will follow in Canada. Of course, there are risks to this. If we were to see some kind of event where commodity prices picked up and that contributed to inflation expectations being higher, the bank might decide to stay a little bit higher for longer. But at this point, our base case is that we will see the cuts towards the middle of this year. I talked a little while ago about a potentially longer lasting drag from housing. And so I wanted to just take a moment here to talk about interest rates and how this will impact mortgage payments. Yes, lower interest rates will be cheered by the most indebted homeowners. It'll be cheered by variable rate mortgage holders. That'll put less pressure on them. But we don't see a significant amount of rate relief coming for homeowners over the next several years, at least not in aggregate. Of course, different people have different arrangements in terms of their mortgages, but in aggregate, payments should stay high because we have to understand how many people bought homes at ultra low rates when the central bank's policy rate was 0.25%, for instance, or below 1%. So there's this wave of renewals that will occur over the next several years that'll result in higher payments, perhaps not the kind of payment shocks that some people have seen in the last year when interest rates were up near 5%. But there is this sort of shock at renewal potential that isn't going to go away necessarily just because rates are at 2.5% instead of 5%. There is still some shocks to be absorbed here. So the implication of this isn't so much instability in the financial system. We're not worried about that. But we do think that it means that over the longer run, there could be this situation where Canadians are putting a larger share of their income towards servicing debt payments. That reduces the amount that household consumption can grow and ultimately contributes to slower economic growth. That's a risk to watch over the next several years. By province, very quickly, I know there was some interest in just getting a regional outlook. We really have to look at exposure to interest rates and to housing. That's the big story at the Canadian level. It's a story for many provinces as well. So we try to divide things into different provinces and their level of exposure. I'm sorry, my screen is just coming up here. I'm just going to close this. Different levels of exposure to high levels of indebtedness to the housing market. The most exposed provinces are Ontario and British Columbia. There's a lot of contribution to their overall economy from the housing market and related sectors. The consumers there have the highest levels of household debt, so they're the most exposed to high interest rates. On the other end of the spectrum, we have the oil-producing provinces, Newfoundland and Labrador, Saskatchewan, Alberta. not only is there less exposure to these effects in those provinces, they're getting a boost from still pretty strong commodity prices and rising production. So the rest of the provinces kind of fall in the middle of those two levels of exposure, but that's the way we divide things up. Another piece that's important to this story, if we're thinking about mortgage renewals, is the saving rate. One thing that we have seen over the last several years is that Canadians are accumulating large amounts of savings. They're holding a lot of money as deposits in bank accounts of various kinds. This has continued to rise even after the pandemic. And that's in contrast to what we're seeing in the United States, where the big levels of savings are starting to be wound down. So there's a few different ways to look at this. Some people say that, higher rates of savings, that'll prevent a more severe recession. People have a financial cushion. And so that is true to an extent in our view. People have more money to be able to deal with higher payment shocks. But one of the things that we've sort of interpreted from these results, particularly when we see that Canadians are saving a lot and Americans are not saving as much, is that Canadians are anticipating there will be this mortgage renewal challenge, that they will need to devote a larger percentage of their income towards servicing debt. So there's already some precautionary saving taking place, and that's something that should weigh on household consumption going forward. So again, not a financial stability risk. We do think that Canadian households will be able to absorb higher payments, but that means that the economic growth outlook for the next little while is at risk of being a little bit more challenging. For affordability, housing affordability, which is the area that so many people are interested in these days, we're not expecting to see a huge improvement. One of the reasons, and this is just kind of looking at the shorter term, in the shorter run, we have a situation where rates are coming down. So the cost of servicing mortgage debt is coming down for many people, but that's also going to offer some support for house prices, even as the economy slows. So there's kind of two forces working in opposite directions. And because of that, we don't think that there will be a meaningful improvement in affordability, at least not in terms of both prices and interest rates over the next few quarters. Population growth is another thing I think that we need to talk about. This was one of the big stories in the Canadian economy over the last year. We had the fastest rate of population growth year over year since the 1950s. And a big part of that was not necessarily immigration coming under the federal government's targets, but a large number of what we call non-permanent residents. So people who come into Canada either as temporary workers or as international students. They're not necessarily supposed to stay within the country's borders forever. They're here for a temporary kind of role that will end at some point. So our view on this is that we'll have a cooling of this effect over the next few years, with economic growth slowing, with less demand for labor from firms in that environment. There will be less need for use of the temporary foreign worker program, and that will lead to a reduction in this category that has driven so much of the population growth we've seen in the last year. We've still got strong contributions from immigration. So that's people who are selected for their ability to contribute to the economy or for family reunification purposes. They're the ones who fit into the 500,000 per year target that you've probably heard about from the federal government. That'll continue to drive population growth and support economic growth, as well as put upward pressure on prices. But we're not expecting to see the kind of surge in that 3 to 4% range that we experienced this past year on an ongoing basis. When it comes to the labor market, I want to make a few points here. I talked a little while ago about the downturn that we're expecting in the economy, not expected to be a severe one, at least relative to some of the recessions that we experienced in the past, the global financial crisis, the 1990s, for instance. One of the reasons for that is that we're coming into this period of slower growth with still a pretty tight job market. There's still a lot of job vacancy rates, not as many as there were a few months ago, but firms are still struggling to fill open positions. And so we think that as we go into this period where the economy is slowing, the calculus on the part of firms won't necessarily be as much about laying workers off to reduce costs. It might just be a question of not filling open positions or eliminating those open job postings. But the economy is still weakening. And one thing that we've been focusing on a lot is not necessarily the rate of job growth, which has still been pretty solid over the last few months, but the employment rate. And what I've plotted here on the right-hand side is kind of a comparison of employment to the employment rate, the amount of employment we would expect if employment were keeping up with population. Essentially, we've got this surge in population growth. We've got temporary foreign workers coming in. There are open job positions that lingered from the pandemic when we had all those horrible job shortages. So the combination of high population growth and open positions is contributing to jobs being created, but not at a rate that's consistent with the population growth, not at a rate that is maintaining the employment rate at where it was. So we need to take headline jobs numbers with a grain of salt. The economy is weakening, the labor market is weakening, even though the Canadian economy is creating jobs in aggregate. Bringing all that together, the unemployment rate's going to go up, we think. Job creation will slow, but we're not predicting an aggregate loss in net jobs over the next year during that downturn. So I'd like to conclude with, I guess, a few longer-term considerations when we think about the Canadian economy, because I know that there was some interest in some of these in lead up here. One of the things that has come up in the last few months is this challenge of GDP per person. Our GDP per capita is declining, and generally that means that the standard of living across the Canadian economy is not increasing, it's declining. So even though our growth is continuing in positive territory, most people don't feel like they're better off because growth isn't keeping up with population growth. If we compare where we are, where GDP per capita has gone, that standard of living indicator, where it's gone over the last year and a half or so, you can see on the right-hand side that it's really close to what we've seen in past recessions. So even though we're not predicting a severe recession, it's going to feel a whole lot like a recession to a lot of people, and that's an important consideration here. So then over the longer run, what we need to be thinking about is how do we improve productivity? How do we stimulate business investment in a way that grows the economy, not just so that it's slightly positive, but so that it's keeping up with population? The best periods of GDP per capita growth in Canadian history have come when the oil and gas sector is doing very well. We saw that in the early 2010s. That is not likely to continue at the same pace that we saw during those periods for a variety of reasons. So we need to be thinking about how to stimulate business investment, because that's the only way that we can make sure that our standard of living continues to improve. I talked a bit about affordability. In the short run, there is this tension between house prices and interest rates. One goes down, the other goes up, and vice versa. So that's part of why we don't see an improvement in the short run. But over the longer run, we need to think about supply and demand. And you may have heard these numbers thrown around. The Canada Mortgage and Housing Corporation says that the amount of building that will occur over the next decade is about 3.5 million units short of what is necessary to bring home prices back to an affordable level. So another thing that policymakers need to be thinking about, another thing that all of us need to be thinking about as we think about affordability, is are we building enough? And so that's got to be a high level of concern for everybody. So finally, I'll talk a bit about geopolitical risks. I mean, I'm not going to predict what China does in Taiwan, or what might happen with the US election and in the aftermath. But generally speaking, those are risks. looking big picture as an economist, what I would say is that global growth is slowing. That's our forecast. That's the forecast of all the international organizations who do these projections. So that's a consideration for Canada as a trading nation, particularly in the US, but for China as well. These are important export markets, and finding ways to grow our trade in an environment of slowing global growth is going to be challenging. In the shorter run, I think what we need to be looking at as we think about some of these geopolitical events that are going on, like what's going on in the Red Sea, is the supply chain index. We saw in the aftermath of the pandemic, there was a huge imbalance between what people wanted to buy and how quickly it could get to them. That resulted in price pressures. It was what initially stimulated this very challenging period of inflation that we've gone through. And one of the things that's happened with this recent Red Sea conflict is that supply chains have become ensnarled again. So there's a risk of further inflaming inflation. And if we're looking for kind of an indicator of what the impacts of some of these conflicts might be, this is where I would start, is looking at supply chains and inferring what that might mean for inflation, for price pressures going forward. So I'll wrap up there, just conclude with where I started. Rate cuts towards the middle of this year, once the economy slows down and inflation becomes more manageable. Population growth should cool, but continue to stimulate the economy. So that'll be a big part of the story. Housing has taken a hit in the last year. Some relief is coming on the rate front, but there is a risk of higher debt service payments going forward for some time, given the rate environment and renewals. So that's something to think about. It's a risk for the Canadian economy. And then we need to think about how to improve housing affordability, how to build, how to stimulate business investment so that our standard of living can go higher. And then there are these geopolitical risks that are at the forefront as well.
But on behalf of all of us at IDC Worldsource and our advisors, thank you very much for taking time today, and we really appreciate your presentation.
Anytime. Thanks for having me.